Hello, my name is Josephine. Today I have a very interesting video for you. I'll be speaking a bit about Sylvamo, an uncoated freesheet producer. I'll first take you through their business and then also why the current share price is low and also our analysis on the company. We think the potential upside is really great. Sylvamo is a spin-off from International Paper that have divested all of their uncoated freesheet production. The uncoated freesheet that Sylvamo produces, they sell to other companies that will produce, for example, envelopes, books and posters out of them. Sylvamo owns 3 mills in Brazil, 1 in Russia, 1 in France and 2 in the US. In the US, they also have an offtake agreement with International Paper to buy all of the uncoated freesheet produced there. In Russia, they have the right to harvest at forest land owned by the Russian government. And in Brazil, they own their own forest land where they grow eucalyptus trees, and they can harvest them in every 6 to 7 years. Sylvamo has a very important position in the market as a supplier, where they are the #1 supplier in Russia and Latin America, the 2nd in North America and 3rd in Europe. Upon distribution, the shareholders of International Paper got 1 share in Sylvamo per 11 share held in International Paper. The initial price on the first day of selling was $33, but they have now recently been pending between $27 and $28. And there are a few reasons why the share price has been low and may be for a while to come. And the first reason is that International Paper held 20% of the shares in Sylvamo, and they have committed to selling off all of these within 1 year. And also the industry of paper production is disrupted, so it may not be very appealing to a lot of investors. The third reason is the lack of dividends. A lot of the shareholders that got their dividends through the distribution from International Paper have been selling their shares since they are used to receiving a dividend, but now they're not. Sylvamo wants to pay dividends, but they can't at the moment. They have a covenant put on them by the bank where they have to reduce their debt because of a tax dispute in Brazil, but they're hoping that by the end of 2022 that they will decrease the level of debt and be able to pay $50 million in dividends, and they may also buy back shares. In our analysis, we have calculated the asset value and the earnings power value. We've done it according to Greenwald's method and at reproduction cost. Some of the adjustments that we made to the asset value is to inventory, where part of it was valued at last in, first out method. So we have reduced it to account for old inventory that may be unsellable or unusable. We have also recalculated the value of the mills and also of the intangible assets, which mainly was relationships and their selling network. And this gives us an asset value per share of $53, and that is almost double the current share price on the market. We also calculated the earnings power value, and this came in slightly lower, but that was something that we expected since it's a mature market and the industry is disrupted. This is our discounted cash flow analysis. Revenue is based on demand forecast by RISI, where in Latin America they were supposed to increase, but in North America and Europe decrease. In perpetuity, we're using -5% growth. We have calculated WACC to be 6%, but we're using 7% in our models to be conservative. We also have a sensitivity analysis in our article where you can see how sensitive the share price is to changes in WACC and the terminal growth. We have also reflected in our model the increase in capex following the change of boilers in the Russian mill. The DCF model gives 44 as the implied share price, and that is closest to the earnings power value, but slightly lower, and that is probably because we're being quite conservative in this model. I also wanted to mention some of the risks with Sylvamo, and one is the declining industry. This is something we have taken account for in our models by reducing the revenue. And also the pandemic has had a big effect on Sylvamo's operations. They had to shut down their mills for a while, and they've also seen a drastic decrease in the demand for uncoated freesheet. This is mainly because offices and schools were closed. And this could have a long-term effect on Sylvamo, since many schools and employers are now more open to a work from home or study from home setup. Sylvamo relies on a third-party provider for transportation of products, and if these are delayed, it could lead to a production stop. The top 10 customers of Sylvamo account for 1/3 of net sales, so it's very important for Sylvamo to take good care of these relationships. So to summarize, the current share price of Sylvamo is low at the moment, since international paper are selling off their share, and shareholders coming from international paper are also selling off their shares because of the lack of dividends. But on the positive note, Sylvamo can generate a good free cash flow in the future, and they have a strong position in the market. So within 1 year, when international paper has sold off their shares and Sylvamo can start paying dividends, this will act as a catalyst to create value for the shareholders. With a revenue of 3 billion, they can increase share price with 60 to 100% plus pay dividends. This is really a great moment to buy Sylvamo shares. Thank you so much for watching. If you like our content, please subscribe to our channel, and I will see you in the next one.